Netflix is falling. But is the business actually breaking? The latest earnings report creates a contradiction. Revenue is still growing. Profitability remains strong. Advertising is expanding. And Netflix continues to operate one of the most powerful entertainment platforms in the world. Yet the stock was punished. The problem may not be what Netflix delivered in the last quarter. The problem may be what investors now expect from the next one. So is Netflix losing its momentum? Or is the market simply demanding more from a business that is still growing? That is the question we need to examine. Netflix delivered a quarter that, on the surface, looked solid. Revenue reached approximately $12.6 billion, up around 13% year-over-year, while earnings came in slightly ahead of expectations. So why did the stock fall? Because the market is not only evaluating what Netflix has already achieved. It is evaluating what comes next. And the latest guidance gave investors a reason to question the pace of future growth. This is the central contradiction. Netflix is not reporting a broken business. But investors may be starting to question whether the company can continue growing fast enough to meet increasingly demanding expectations. The market reaction was not really about whether Netflix had a good quarter. It was about whether the company is still growing fast enough for the expectations built into the stock. Netflix's outlook pointed to revenue growth of approximately 12% for the next quarter. That remains a strong growth rate for a company of Netflix's scale. But when expectations were slightly higher, the difference suddenly mattered. This is how the market works. A company does not have to miss badly to disappoint investors. Sometimes, it only needs to grow slightly slower than expected. So the issue is not that Netflix stopped growing. The question is whether its growth is still fast enough for Wall Street. If revenue is still growing strongly, then where is the real concern? One answer is engagement. During the first half of 2026, Netflix's global viewing hours increased by approximately 2%. That is still growth. But for a company built around capturing consumer attention, the pace matters. Netflix is no longer competing only with other streaming platforms. It is competing with YouTube, social media, gaming, and every other form of digital entertainment. So the question is not simply whether people are still watching Netflix. They clearly are. The more important question is whether Netflix can continue increasing the amount of time consumers spend on its platform. Because engagement ultimately supports both pricing power and advertising potential. But a modest slowdown in engagement should not be confused with a loss of competitive advantage. Netflix still possesses one of the most difficult assets to replicate in global entertainment: scale. Its platform reaches hundreds of millions of households across international markets. That scale allows Netflix to distribute content globally, spread production costs across a massive audience, and monetize successful content in multiple markets. This is a structural advantage that most competitors cannot easily recreate. So the key question is not whether Netflix has lost its competitive position. The evidence does not suggest that. The challenge is whether Netflix can continue converting that enormous global scale into new layers of growth. One of the most important opportunities in Netflix's next phase is advertising. The logic is compelling. Netflix already has something advertisers value: a massive global audience and valuable viewing behavior. But the advertising business is still relatively young. Netflix must build the technology, attract advertisers, improve targeting, and prove that its audience can be monetized at scale. If successful, advertising could create a meaningful revenue stream on top of the existing subscription business. But investors should separate potential from proven results. Advertising is clearly a major opportunity. The question is how quickly Netflix can transform that opportunity into a meaningful, scalable business. Netflix has demonstrated significant pricing power. Over time, the company has increased subscription prices while continuing to grow its business. That is a powerful advantage. But pricing power is not unlimited. Every price increase raises the same question. How much more will consumers continue to pay before engagement or retention begins to suffer? This matters because Netflix is now operating at enormous scale. Future growth cannot rely indefinitely on simply charging more. The company must combine pricing with stronger content, higher engagement, and advertising. That is why Netflix's next phase may be more complex. The challenge is no longer simply monetizing subscribers. It is increasing monetization while keeping the platform valuable enough for consumers to stay. Netflix is often compared with Disney, Amazon, and other streaming platforms. But the competitive landscape is now much broader. Netflix is competing for consumer attention. Every hour spent watching YouTube, scrolling social media, playing video games, or consuming short-form content is time that cannot be spent on Netflix. This is why engagement matters so much. Netflix does not need to defeat every competitor. But it must continue winning a meaningful share of consumers' limited free time. And while Netflix still has enormous scale, the battle for attention is becoming increasingly fragmented. The question is no longer simply, which streaming service has the most content? It is, which platform can remain essential to consumers? This may be the most important conclusion from the latest earnings report. Netflix is no longer in the early phase of proving that streaming can become a global entertainment business. That has already been accomplished. The challenge now is different. Netflix must demonstrate that a company of this enormous scale can continue generating strong growth. That growth may come from higher prices, advertising, stronger engagement, and more effective monetization of its global content ecosystem. But each new growth engine must become meaningful at Netflix's scale. This is why the latest earnings report matters. The question is no longer whether Netflix has a successful business model. The question is whether the next phase of growth can be as powerful as the first. This is where the real debate begins. The bullish argument is clear. Netflix is still growing revenue at a double-digit rate, generating substantial profit, expanding advertising, and operating one of the strongest global entertainment platforms. From that perspective, the market reaction may have focused too heavily on a relatively modest difference in forward guidance. But the bearish argument also deserves attention. Growth is slowing. Engagement growth is modest. And Netflix must prove that its newer initiatives can create meaningful incremental growth. Both arguments can be true at the same time. Netflix can remain an exceptional business while becoming a more difficult growth story. And that may be exactly what the market is trying to price in today. Not a broken Netflix, but a Netflix that now has to prove more. The next earnings reports will tell us much more than whether Netflix beats or misses a single revenue estimate. Investors should watch the direction of the business. Is engagement accelerating? Is advertising becoming a meaningful contributor to growth? Can Netflix continue raising prices without damaging retention? And perhaps most importantly, can the company sustain strong growth as its revenue base becomes increasingly large? These are the indicators that will determine whether the latest sell-off was simply a reset in expectations, or an early signal of a more structural slowdown. For now, Netflix still has powerful competitive advantages. But the next phase of the story will be judged by one thing. Can the company continue creating new growth at massive scale? So, is Netflix actually breaking? Based on the latest earnings report, the evidence does not point to a fundamental breakdown. Revenue is still growing. Profitability remains strong. Netflix continues to operate at extraordinary global scale. And advertising offers a potentially important new source of monetization. But the next phase will be more demanding. Netflix is no longer simply competing to become the world's leading streaming platform. It must now prove that a business of this size can continue creating strong growth. So perhaps the real issue is not that Netflix is broken. The market may simply no longer assume that growth will come easily. Netflix is still a powerful business. But from this point forward, growth must be earned. Netflix is not broken. The latest earnings report shows a business that is still growing, still highly profitable, and still operating at extraordinary global scale. But the investment story is changing. The next phase will depend on whether Netflix can turn advertising into a meaningful growth engine, maintain engagement, and continue monetizing its global audience without relying too heavily on price increases. The market may be demanding more because Netflix is no longer an emerging growth story. It is now a massive global platform. And at this scale, growth cannot simply be assumed. It has to be earned. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.